Hello and welcome to Bank Read. In this video, you'll get to know the portfolio of interest rates and exotic options in the dynamic market environment. So let's get started. The cause of interest rate risk. Risk arises for businesses once they don't recognize what's getting to happen within the future. Therefore, clearly there's a risk connected to several business choices and activities. Rate of interest risk arises once businesses don't know how a lot of interest they could have to be compelled to pay on borrowings, either already created or planned, or how a lot of interest they could earn on deposits, either already created or planned. If the business doesn't recognize its future interest payments or earnings, then it cannot complete an income forecast accurately. It'll have less confidence in its project appraisal choices. As a result of changes in interest rates could alter the weighted monetary cost of capital and also the outcome of web gift value calculations. There is, of course, continually a risk that if a business had committed itself to variable rate borrowings once interest rates were low, an increase in interest rates may not be property by the business, then liquidation becomes a prospect. Note rigorously that the first aim of the rate of interest risk management isn't to ensure a business the most effective attainable outcome, like the bottom rate of interest it might ever have to be compelled to pay. The first aim is to limit the uncertainty for the business in order that it will arrange with larger confidence. Traditional and basic approaches. Matching. When taking away a loan or depositing cash, businesses can usually have an alternative of a variable or fastened rates of interest. Variable rates are typically called floating rates, and that they are typically set with regard to a benchmark like LIBOR, the London Interbank Offered Rate. Smoothing. In this straightforward approach to rate of interest risk management, the loans or deposits are merely divided in order that some are fastened rate and a few are variable rate. Gauging borrowings. If interest rates rises, solely the variable rate loans can value add, and this can have less impact than if all borrowings had been at variable rate. Deposits are equally ironed. Exotic option. Exotic choices are a class of choices contracts that take issue from ancient choices in their payment structures, expiration dates, and strike costs. The underlying plus or security will vary, with exotic choices providing additional investment alternatives. Exotic choices are hybrid securities that are usually customizable to the requirements of the capitalist. The capitalist has the correct to shop for the underlying security with a decisive choice, whereas a place choice provides them the flexibility to sell the underlying security. The method wherever a choice converts to shares is named effort, and also the value at that it converts is that the strike value. Exotic choices are choices contracts that take issue from ancient choices in their payment structures, expiration dates, and strike costs. Exotic choices are custom to satisfy the chance tolerance and desired profit of the capitalist. Although exotic choices offer flexibility, they do not guarantee profits. Types of exotic option. Chooser choices enable a capitalist to decide on whether or not the choice would be a place or decision throughout an explicit purpose within the option's life. Each the strike value and also the expiration are typically identical, whether or not it's a place or decision. Compound options are choices that offer the owner the right, not obligation, to obtain another choice at a particular value on or by a particular date. Barrier options are kind of like plain vanilla calls and puts, however solely become activated or destroyed once the underlying plus hits a predetermined indicator. A binary options or digital options pays a set quantity given that an occurrence or value movement has occurred. Bermuda options are exercised at predetermined dates similarly because of the ending date. Bermuda's choices would possibly enable a capitalist to exercise the choice solely on the primary of the month. Quantity adjusting options, referred to as quanto choices for the brief, expose the customer to foreign assets, however offer the protection of a set rate within the buyer's home currency. Look-back options don't have a set exercise value at the start. Instead, the strike value resets to the most effective value of the underlying plus because it changes. Asian Margin options take the typical value of the underlying plus to work out if there's a profit as compared to the strike value. Basket options are kind of like plain vanilla choices except that they're supported over one underlying. Extendable options enable the capitalist to increase the expiration date of the choice. The underlying plus for unfolding options is the unfold or distinction between the costs of two underlying assets. A shout options permits the holder to lock in a